Greetings, Ed Yardeni here. Well, what can I say? It was a good summer for us. Weather was good, and now we've got some rain outside today. First day of going back to work, so it's a good day to go back to work because it's not very nice outside. I hope you all had a great summer, and now it's time to roll up our sleeves and get back to all the action here in the markets. We started out the day with the market taking a little bit of a dive, not too bad really, but then it came back. The good news is the ISM non-manufacturing survey came in a lot stronger than anybody thought, a lot stronger than I thought, because I was basing it on what the S&P global indicator was for the ISM non-manufacturing. They do one on a flash basis, and it was very weak, whereas the ISM was actually strong across the board, with one important exception. The price index has come down. Well, a couple of important exceptions. The price index has come down, so that's good for those of us looking for a peak in inflation. And the other thing that happened is the backlogs of orders has declined. Delivery times have declined. So again, that suggests that supply chain disruptions are pretty much abated significantly, which goes hand in hand with the notion that the supply side of the domestic and global economy are getting some relief from the supply chain disruptions. Well, that's Oscar down there. Let me see if there he is. He likes to sleep right down there while I'm talking. And again, I hope my voice doesn't put you to sleep. We had this ISM numbers that were really quite good, really, as I said, across the board. But then this morning, there was plenty of bad news, horrendous developments for Europe. I mean, the horrendous really applies to the war in Ukraine. Terrible is what applies to the consequences of that war. The Europeans joined us and others in sanctioning Russia, and Russia turned right around. And as of Monday, basically said that they're going to significantly cut their exports of natural gas to Europe. So once again, energy prices are soaring, electricity prices are soaring. People are demonstrating for relief. Governments are responding with attempts to provide some relief. Interestingly, in the first half of the year, Europe was doing actually pretty well. They had done well because their lockdowns had been lifted, and that's when they started to really feel the full impact of a freer, more open economy. Whereas here in the United States, we've experienced what some have called a technical recession. I've called it a growth recession. Whatever it is, it hasn't been much growth compared to Europe. And now it looks as though we're going into the second half of the year where the US economy should have some positive growth. Not much, but some positive growth, kind of still consistent with a slow growth economic outlook, a mild recession outlook, perhaps. But Europe looks as though it's going to go into fully into a recession. And now, apparently, they have been able to stash away some natural gas and get ready for the winter. Maybe they'll be lucky and the weather won't be too cold. But I'm thinking, even if they get through the winter, then what? They still need a lot of natural gas to operate their electricity, to operate their companies. So this is a problem that they're going to have to scramble to deal with pretty rapidly. And obviously, what they're doing is they're reconsidering rather quickly whether they really should be as independent of natural gas and other fossil fuels as they've been targeting. Then, of course, we had news out of China. There are now roughly 60 million people that have been locked down by the communist government. It's a zero COVID policy. It's a insane policy. I just don't understand. Is it a matter of pride that they don't want to buy the vaccines from Moderna and Pfizer? I just don't get it. Because obviously whatever they injected people with didn't work at all. And now they're playing whack-a-mole with the COVID 3 years into it, whereas the rest of the world has opened up really pretty much across the board. So it's been really phenomenal, the extent to which the rest of the world has been relieved of this pandemic. My wife and I are going to go to Austria and Hungary on a vacation on Wednesday, and we don't need any documentation whatsoever. Whereas in previous overseas trips, we've needed documentation on COVID. And then, of course, on top of everything else in China, they got that property bubble bursting. All their property companies I think almost all of them have defaulted on their debt, and they're seeing their orders taking a dive. And of course, the zero tolerance for COVID only makes that worse, because people in a lot of cities are locked down, and they're not about to go. They're not in the position to look for real estate. And then our good friends at OPEC Plus. So the plus is Russia, so they're not good friends there, obviously. But the Saudis certainly went along with the idea to cut OPEC Plus production by 100,000 barrels in October. It's supposed to be just for the month, and then they'll reconsider it. But this is certainly a slap in the face in Biden's face, because he went over there and basically pleaded with them to increase output. Here they are cutting production. I think it's in their interest to increase production and to bring the price of oil down, given the recessionary pressures that are building in the global economy and in Europe and China and some emerging economies that are finding that the Fed's tighter monetary policy is creating problems for them. I know Zambia is sort of isn't exactly a widely invested in emerging economy, but apparently they are defaulting on their debts, as Sri Lanka's done it. The Chinese look like they're going to get holding the bag with a lot of worthless debt for this Silk Road initiative that they had, building lots of infrastructure in emerging economies that now can't pay. The fallback for the Chinese is that there's a clause in most of those contracts that they take ownership, but that in turn creates political backlashes in the countries that they were trying to help or claim they were trying to help. So meanwhile, here, the question is, and it's the question that's I'm addressing in tomorrow morning's morning briefing, and that is, will TNEC survive a global recession? Can it survive a global recession? If Europe goes into recession, China goes into recession, well, certainly if Europe goes into recession and China's in recession, China's recession is going to be worse, because I think 20% of Chinese exports go to Europe. So, the Chinese have an incentive to try to get this war over with, because it's going to come back to bite them through their business in Europe. But hey, sometimes people don't act in their own rational best interests and do stupid things for political reasons, which is what the Chinese government is doing. But here in the United States, we got our own problems, of course. But I think TNEC, there is no alternative country, still works. I think as global investors look around the world for work they can park their money and it'll be safe, it's the United States. So this morning, I'm looking at the screen here, the dollar's strong. We've had this, I guess we now have reversals on an hourly basis. So we had a reversal on Thursday, a reversal on Friday. Now this morning, we've had a reversal. So I'm going to have to get my neck brace for all these reversals. But I think the dollar is demonstrating that these problems around the world are making people want to come to the U.S. And they're not just buying dollars and putting them under their mattress. They're buying dollars and investing them somewhere in dollars. I think they've been doing that in the fixed income markets, though, again, the bond yield is under some pressure. Here it's up above 3, it's a 3.3. Maybe it'll test 3.5. I don't know if it goes any higher than that. If nothing else, I think foreigners will jump in with their dollars. And then, foreigners have not been participating in the U.S. stock market, and maybe we'll see them coming in as well. The problem that I have is the data that I use from the Treasury is usually a couple of months old by the time we figure it out. So all I really can do is stare at the trade-weighted dollar, and as I see it going up, ask myself, what are they buying with all these dollars? And it's got to be bonds, it's got to be stocks. I kind of doubt it's real estate under the current circumstances. Let's go to the tape here and see what we can find to discuss relative to this conversation we're having. First of all, I just want to get you hooked on the website again. There's on the website, there's a section called U.S. Economy. There's something called Purchasing Manager Surveys. So today, September 6th, within about a few nanoseconds of when the data became available to our data vendor, the non-manufacturing Purchasing Manager Survey was posted. So let me just start out. We're just kind of having a gander at that real carefully here. There we go. That's manufacturing. We know that looked weak, but it still maintained a reading above 50 for the overall index. Now here's the NM PMI, the non-manufacturing PMI, and you can see that there was actually a slight uptick to 56.9 in the index. It's come down, but that's a pretty good reading. This was an unusually strong reading back here. And then business activity, or what they call production, that was up. The orders index on the left side there is up. Employment is kind of neither here nor there. It's kind of interesting because the manufacturing is also kind of on the weak side. It certainly doesn't jibe with the strength in the labor market. Supplier deliveries, again, the supply chain issues have abated there as well. And then inventories, well, I guess it's hard. Doesn't really mean much in non-manufacturing. But by the way, non-manufacturing includes construction, which is something that people don't always understand. Exports were actually pretty good. Again, I don't know what that means. Imports are kind of just volatile. Backlog of orders, along with the supplier deliveries, an indication that supply chain disruptions are abating. And then the prices paid still high. So we're not getting super duper relief. And then back on the manufacturing survey, the prices paid came down a lot more. And so that's encouraging. Now let's go to the charts for the morning briefing that you folks received an advance copy of yesterday at 3 p.m. New York time, and this morning at 5 a.m. So here's, I'm really focusing on the question of what's wrong with interest rates being at 3 to 4%, if that turns out to be a return to the old normal. I think it's a possibility. And so I know there's a lot of concerns that 3 to 4%, everything's going to blow apart, but the credit system's holding in pretty well. The banks are in good shape. Maybe we don't get a credit crunch this time around. I know when you look at the yield curve, I've made the point that the yield curve doesn't necessarily forecast recessions. It forecasts financial crises, which would then become credit crunches, economy-wide credit crunches, which then turn into recessions. I mean, that might be, too weird kind of a logic. So if at the end of the day it's forecasting a recession, it's forecasting recession. But I say that just because in this figure 1, you can see that there is a interesting relationship between the yield curve ascending and then something blowing up, and then the yield curve narrowing again. And in the current situation, now we've had this is the 10 versus the Fed funds rate, which is actually the official component of the leading economic indicators. It's not the 10 to 2 year, but the 10 to 2 year certainly is a good leading indicator for this one. And so when the Fed went 75 basis points recently in raising the Fed funds rate, this spread narrowed substantially. And then assuming they do another 75 basis points at the September meeting in a couple of weeks, that would imply that that'll be negative and just be another one of the 10 leading indicators suggesting that the risks of a recession are increasing. So here we just spent all this time having all this agita on the first half of the year that we're in a recession. And now that it's not that clear that we're in a recession, we're going to get leading indicators telling us it's still an issue. But again, when I look at this indicator, to me, it suggests that something is going to break in the credit system. Maybe it'll break in the credit system overseas, but to the extent that the credit system isn't likely to have a credit crunch, then maybe we can have a rolling recession as opposed to just a recession that hits everybody all at the same time. Again, this is just a little nostalgic chart here showing you that we are at 3 to 3.5% on the 10-year Treasury. Just to remind everybody, we've been here before without any doom and gloom. We've been here before with the economy set to continue to expand at a gradual pace. So there's nothing inherently terrible about 3 to 3.5. Actually, it's a good thing if we go back to the old normal, to the extent that people will have an alternative to stocks and real estate. There'll actually be a choice of various assets, and one of them will be bonds yielding 3 to 4%, which is not a great deal if inflation doesn't come down, but we're expecting inflation to come down. Now, the history of inflation is here back to 1921. And as I've shown you before, this is a little bit unsettling because it does show that the best way to bring inflation down, or the sure way to bring inflation down, is to have a recession. And it also implies that one of the reasons we have recessions is because the central bank, the Fed, tries to get its credibility back and tightens monetary policy to bring inflation down. And on the way to doing that causes a recession. And that's, I guess, what everybody's spooked about right here. There was a good, not a good one, but there's a kind of an interesting inflation here right after the war, World War II, where the soldiers came back and they all were forming households. They needed consumer durable goods, and Ford was making bombers rather than cars. So durable goods inflation really took off here in the CPI, and then it came down substantially. And that it didn't take a recession to do that. The recession over here obviously picked up the pace in bringing inflation down. But I guess I'm arguing kind of a happy scenario here where it goes up and then starts coming down. They do tend to be pretty symmetrical. So what goes up quick sometimes can come down quickly as well. We know gasoline prices have come down. We know that used car prices have come down. We know that a lot of the components of the CPI that were troublesome, like airfares and lodging, all those inflation rates are coming down. So I'm optimistic that we can do it without an economy-wide recession, but with a rolling recession, hitting different sectors at different times. Here's just that chart again, looking at the 10-year minus 2-year as a leading indicator for the official component of the leading indicators. Okay, so headline inflation, again, there's headline inflation on a consumer price basis, CPI and the PCED, the headline, and here's the core. We discussed in the morning briefing why we think they're moderating here. Food, of course, has been an issue, and we're seeing agricultural commodity prices coming down. It could take a little while for those to affect the food CPI. Food CPI is also affected by things like transportation costs, and so energy is a very important component of food inflation. And we are seeing some signs that energy inflation is coming down. It's true that OPEC announced a cutback of production by 100,000, but it's only 100,000. Americans have cut back their consumption of gasoline by something like 600,000 compared to a year ago. So I think there's still going to be, I don't think oil prices are going up, let's put it that way. To bring inflation down, things don't have to go into deflation mode. They just have to stop going up for a while. And I think that's likely. Here's the agricultural index on food that's come down. Here's the gasoline pump price. We monitor the 4-week moving average and compare that to the CPI. And we were pretty clever, if I may say so myself, in kind of adjusting the scale so that they're exactly the same scale. So you get a pretty good indication that whatever's happening in the 4-week moving average of gasoline prices is going to happen through the end of August in the CPI version, which is also the PCED version. Here's what I mentioned before. Sometimes my mouth is faster than my charts, but here, just to catch up with what I was saying, in the charts, you can see that gasoline consumption in 2022 is 8.9 million barrels during this particular week. And at the same time, back in 2021, it was 9.5. So you can see that even during the summer driving season, people looked at that pump price and said, figure out ways to travel less. By the way, if you're in California and you got yourself an electric vehicle, I'm sure you're not happy with the state now asking you to not to charge up your car because of the heat. They've got to conserve energy. So unintended consequences of well-intentioned policies, I guess. Used car prices are coming down. That should help. Now, let's just quickly go through the rolling recession, see if I can do that in a couple of minutes, and then leave some time for some questions. I think I already have a couple here. So payroll employment is a component of index of coincident indicators. And so it's hard to say that we're in a recession when you've got payroll employment in an all-time high. It's one of the four components of the coincident economic indicators. It's leading indicators that are predicting that we're going to have a recession sometime early next year. They peaked in February and they're still declining through July, and August preliminary indicators look on the weaker side. This is, if you take payroll employment, multiply it by the number of hours per week that people are working on average, you get total hours worked in the economy, in the private sector. And you can see that even though the payroll employment number was really quite good, it was offset by weakness in the number of hours worked on average during the week. And so you can see that that was actually flat. And that obviously has implications for another leading coincident economic indicator, and that's personal income. Personal income is adjusted for inflation, is included in the coincident indicators, and we monitor what we call the YRI earned income proxy, which just takes those total hours worked from that previous chart and multiplies it by average hourly earnings, and you can see it's a pretty good correlation. So it looks great. Even though total hours worked were flat, wages were up 0.3. The problem is inflation. Well, maybe we'll be lucky and find that the August CPI and deflators 0 or negative. Then that would be consistent with what we saw in July, which is an increase in the real purchasing power of wages. Rolling recession time. The auto industry is in a rolling recession. It's not because of demand, it's because of supply. But a slump is a slump. It's a recession. It means that there's a lot of pent-up demand for cars, and as the auto industry finds the parts that they need to make cars, this should improve. So I think the auto industry already has been in a rolling recession and isn't going to get any worse. Look at residential investment, that's housing related, and you can see that we had some real weakness in the second quarter, but I really Debbie and I really dug into the data and found that a lot of the weakness was in brokerage commissions. It makes sense. We all think of residential investment as mostly housing starts, but actually it includes things like improvements on residential structures, which have been coming down. People are not moving as much, so they're not improving the homes that they just moved into, and the brokers are doing less business. So the bad news for the housing industry, at least from a macroeconomic standpoint, is the starts decline that we've had the past few months. That hasn't even gotten into the Q2 private residential investment in real dollars. So that's still got some downside going into the third and fourth quarters. On the other hand, while single family residential looks like it's falling into a recession, it is in a recession, the multifamily is holding up quite well, even with interest rates going up. Rents have been going up so quickly that their landlords have an incentive to build more units, and we need them. So that's looking kind of flat. It's not looking recessionary per se, but the building permits kind of confirm that. The multifamily is up, the single family is down. Value of construction put in place. Well, again, that's useful for looking at home improvements and homes as in residential investment. Non-residential is basically structures, capital spending, private sector structures, and that's kind of going nowhere fast. We look at the breakdown of that, and there's some areas of strength, some areas of weakness, nothing that looks like kind of across the board recession. And maybe hotels, but again, across the board, no. And here's the public. That's the one that we're waiting to see whether all of these build better, back better, or whatever you say, whether any of that stuff is going to show up in these numbers here. There's a lot of environmental issues when you try to build anything. Things take forever to get started, and so on and so forth. So it may be that a lot of money is going to sit around to build infrastructure, and it'll take a while to have that make an impact. But at least it's not going to be contributing to a recession. Then another indicator here, industrial production. You can see that when the income data comes out, sorry, let's do that again. When the employment data comes out, we calculate this series, which is aggregate the weekly hours in manufacturing. And you can see that's been sort of in a flatline coma. And that suggests that industrial production is also kind of likely to be declining. So that's a quick run through. Let me unshare the screen. Got a nice group here of about 150 folks. I don't see 150 questions, fortunately. So I hope I was clear on some issues. Oscar decided to leave, so he's not here. I would have introduced you more formally. Okay, thank you, Ed. Is it? This is from Paul. Is it possible that all of those dollars being purchased by foreigners are going into U.S. Treasuries, given all the new supply from QT and current fiscal policy? Yeah, that's kind of been my story. You know, we look at the monthly TICS data that comes out from the Treasury, and the TICS data does in fact show you on a monthly basis foreign net inflows into the U.S. And I've shown that over the past 12 months through, I think it's June. No, it's June. Maybe it's May. Anyways, the past 12 months of available. Oh, there he is. The past 12 months of data. Hey, Ashley, you want to come here? Come here. He doesn't respond to my requests. He's an independent thinker. So anyways, the data shows that something like $1.5 trillion came into the U.S. over the past 12 months, and something like 800 billion of that came into the fixed income markets, with a sizable amount in treasuries. And that's kind of my argument about QT. Yeah, QT could turn out to be a disaster, to see this balance sheet unwind by 95 billion per month after winding it up by 120 billion per month. That's got to have some impact on bond yields. But on the other hand, TNEC may offset that. Maybe the foreigners will be buying, and maybe just risk-averse investors, even in the United States, will be buying. So so far, the market knows QT has started with a vengeance as of September, and yet we'll see. I don't want to jinx it here. We're at 3.324%, which is not too bad under the circumstances, when we know that the Fed's going to be doing 75 basis points. I think we know it's going to do 75 basis points. And then after that, maybe some more, and QT is going to be happening at a clip of 95 billion per month. Brian, you aren't expecting a credit crunch in the US, and I agree with that assessment. Given what you said about the real estate market in China, do you expect a credit crunch there, and do you expect that to put pressure on global markets in the near future? Yeah, that's kind of part of my shtick here, part of my story. The idea that we shouldn't start out focusing on the United States. We really need to look at the global economy. Europe was doing fine in the first half of the year, and the second half of the year, it looks like it's going to be troublesome going into the first half of next year. Again, once the winter's over, they're still going to need natural gas. And China's property bubble burst about a year or so ago. And the difference between China and the United States is they're authoritarian, and they might be able to manage these things better in terms of what we can visibly see, but it doesn't mean that the underlying problem isn't as terrible and as treacherous for them as it was for us in 2008. I guess the difference between us and them is we let Lehman fail. They should have just fired all the people they didn't like at Lehman and keep it in business, and then maybe we wouldn't have had the great financial crisis. I think the market was only down about 20-25% before Lehman blew up, and then it was down 50% following that in a heartbeat. It doesn't look like the Chinese central authorities are going to let whatever their Lehman is blow up. Maybe it's Evergrande, but they're scrambling to try to keep it together. As you know, state governments, provincial governments get a lot of their revenue by selling state land to developers. Well, that's kind of done. So the provincial governments are going to be hard pressed to kind of come up with funds to build infrastructure that nobody needs. They're building all these trains to nowhere that they don't have enough people to take. But yeah, I think China, Europe, recession is kind of the outlook, and the U.S. is going to have rolling recession, and on balance, be where you want to be. Lewis, will the Bank of England hike interest rates 0.75% this week to shore up the British pound before new PM Liz Truss starts as a chance to criticize the central bank? Yeah, it kind of makes sense that they'd want to kind of get that through there. Though I don't know, I think they still view themselves as fairly independent. So I don't know that they really would time it because Liz is going to be coming in. She obviously wants to be Margaret Thatcher. She wants to be Ronald Reagan. She wants to cut taxes. And for that to work, I guess she's kind of a modern monetary policy person in some ways. The MMT people believe that the government should spend more and the central bank should finance the deficit. The conservatives like her believe that you should cut taxes and finance the deficits too, with at least with low interest rates. So maybe there's something to that thought process. But the Fed has pointed out rightly that there's nothing they can do about the supply side of the economy. And all they can do is depress demand to bring it down in line with supply. And that's what brings inflation down. Very simple macroeconomic analysis. I have a feeling things are a little bit more complicated than that. But in Europe, it's pretty straightforward. Energy is the problem. They've got a major energy crisis. They did not think about the transition from fossil fuel to clean energy. They didn't think about the geopolitical consequences. So they're really in trouble right now. And there's not much they can do other than to depress demand. But guess what? These electricity prices are going to depress demand. So I think the central bank there and the ECB should just say, you know what? This is nothing we can fix with higher interest rates. We can't bring inflation down with higher interest rates. And that's only going to create a horrible depression. And as it is, the recession is going to occur from the energy crisis. So that's what I would do if I was running monetary policy over there. But then maybe it's fortunate that I don't. Bing, from your recent morning briefing on the rolling recession currently underway in housing, would it be safe to assume that you don't subscribe to Edward Lemur's proposition that housing is the business cycle? I haven't seen that one. I'll Google it and see. I wasn't aware of that particular thesis, but I do agree that we've got a global housing recession. And so to the extent that we're talking about a global recession, the epicenter of that is once again probably property. So I have no issues with that. But when it comes to the U.S. is may have a housing recession, but we've got lots of other cylinders that are still going strong. I sent out a QuickTakes last night about the transportation industry. They're still hiring truckers at a record high. That tends to actually be a leading indicator. So I think my mantra is TNEC. There is no alternative country. And I think we're going to call it that. I'll look at some of your other questions. I'll try to address them in our morning briefing and the quick takes. Hope you're finding the quick takes useful. Hope you're tuning in every Monday to this. I'm not quite sure what I'm going to do. I may pre-record something for next Monday. I'll be visiting not the Trumps, but the Traps from the Sound of Music. So I'm going to see if the Hills are alive with the Sound of Music. So while I'm doing that, I hope you have a good week and good 2 weeks. But I'll be communicating one way or the other, and I've already got the head start on some of the morning briefings, and the quick takes will be out one way or the other. Thanks, everybody.